Welcome back to our channel, where we dive into timeless books that can transform your financial future. Today we're uncovering the top 10 key summary points from one of the most iconic books ever written on investing, The Intelligent Investor by Benjamin Graham. Whether you're a beginner or seasoned investor, this book is considered the Bible of value investing. So grab a notebook, because in the next 6 minutes you're going to gain powerful insights that can help shape your approach to building wealth through smart, rational investing. Firstly, understanding the difference between investing and speculating. Benjamin Graham emphasizes a foundational concept. There's a vast difference between investing and speculating. An investor buys assets after careful analysis and expects a return based on the underlying value. In contrast, a speculator bets on price movement, often driven by emotion and trends. Graham warns that many people think they're investing when they're actually speculating. This distinction is crucial because it sets the tone for rational decision-making. When you invest, your actions are based on analysis and margin of safety. When you speculate, you're gambling. He doesn't say speculation is always bad, just that you should be aware of which you're doing. Understanding this helps you build a disciplined mindset, immune to market hype and fear-driven decisions. It's your compass in the emotional rollercoaster of the stock market. Next is the concept of Mr. Market. Graham introduces the character Mr. Market to personify the stock market's emotional nature. Imagine Mr. Market as your business partner who offers to buy or sell shares every day at different prices. Some days he's euphoric and offers high prices, other days he's depressed and offers bargains. The point? You're not obligated to take his offer. Instead, you use his irrational behavior to your advantage. When he's overly pessimistic, you can buy low. When he's overly optimistic, you can sell high. This metaphor helps investors avoid panic and impulsive decisions. It encourages a calm, objective view of market fluctuations, rather than reacting to every swing. Mr. Market teaches us that volatility is not a threat, but an opportunity. Mastering this mindset is what sets intelligent investors apart from emotional traders. The next core principle that Graham discusses is the margin of safety. This means buying investments at a significant discount to their intrinsic value. Why? Because no matter how good your analysis is, the future is uncertain. The margin of safety protects you from errors in judgment, unforeseen market downturns, or business failures. It's a buffer that gives you room for mistakes without catastrophic losses. For example, if you believe a stock is worth $100, don't buy it at 95. Wait until it's 70 or 60. That way, even if you were slightly wrong in your valuation, you're still protected. This concept applies not just to stocks, but to all investment decisions. Intelligent investing is not about taking unnecessary risks. It's about minimizing risk while maximizing opportunity. Next, Graham talks about defensive and enterprising investors. Graham classifies investors into two categories: defensive and enterprising. Defensive investors prefer a passive, long-term approach. They focus on stability and minimal effort, investing in diversified portfolios like index funds or blue-chip stocks. Enterprising investors, on the other hand, are willing to spend time analyzing companies, markets, and trends. They seek undervalued opportunities and are comfortable with active management. Graham doesn't say one is better than the other. Instead, he urges you to know your temperament, knowledge level, and time commitment. Many people lose money trying to be enterprising when they lack the discipline or expertise. Choosing the right style ensures you're working with your strengths, not against them. Self-awareness is as crucial in investing as analytical skills. Lastly, Graham says avoid the noise and focus on fundamentals. In today's digital age, investors are bombarded with news, stock tips, and predictions. But Graham insists, don't get caught up in market noise. Focus on fundamentals, the financial health of a company, its earnings, debt levels, business model, and competitive advantage. The intelligent investor ignores fads and hot stock picks. Instead, they look at tangible metrics and long-term value. This doesn't mean you need to be a financial wizard. It means developing a checklist and sticking to it. Patience is key. Graham says that in the short run, the market is a voting machine, but in the long run, it's a weighing machine. True value will always shine through, even if the market takes time to recognize it. Keep your eye on the data, not the drama. There you have it, 5 of the most powerful principles from The Intelligent Investor by Benjamin Graham. Let's quickly recap. 1. Investing versus speculating. Know the difference. 2. Mr. Market. Use volatility to your advantage. 3. Margin of safety. Always protect your downside. 4. Investor type. Know if you're defensive or enterprising. 5. Focus on fundamentals. Ignore the noise. These timeless lessons have guided legendary investors like Warren Buffett. In the preface of the book, Buffett shares his insights. I read the first edition of this book early in 1950 when I was 19. I thought then that it was by far the best book about investing ever written. I still think it is. Remember, being an intelligent investor is more about mindset and discipline than chasing the next big thing. If you found value in this video, don't forget to like, subscribe, and hit the notification bell for more in-depth summaries and financial wisdom. Thank you for watching. Until next time, happy investing.